Most traders lose money for one simple reason. They use the right strategy in the wrong market condition. Today, I'm going to show you exactly how to identify market structure. Know whether your market is trending or it is ranging. How to match your strategy to the right condition. And how this one skill alone can save you massive amounts of losses. So, I ask you to ensure that you watch this video to the end, because aside from this highly profitable skill I'm going to be sharing with you in this video, I also have a very important special gift for you. But I'm going to be sharing it only with those who watch this video to the end. Subscribe to my channel and ensure to engage with this video by liking and commenting. So let's dive right into it. Every trading strategy on earth fits in one of two categories. It works in the trending market or it works in the ranging market. But the mistake traders make is they never stop to ask themselves, what market condition am I even trading in? They just apply the same setup everywhere. Breakout, retest, reversal, without even checking if the market is cooperating. And the truth is, a trending strategy is going to bleed you in a ranging market, and a ranging strategy will bleed you in a trending market. And this is why consistency feels impossible for most traders. It's not because the strategy is bad. It is because the environment is wrong. Let's start with a trending market. This is where most traders feel confident. Now, how do we identify a trending market? There are two kinds of trends. We have an uptrend and we have a downtrend. In an uptrend, what do you want to see? So this is the chart of gold. And in this chart of gold, you would see we have mainly an uptrending market. You can see where the price is coming from and see how the price continues to move all the way up. Now, apart from this, what helps us to identify this market, aside from the fact that the market is mainly moving to the upside, what helps us to understand and identify that we have an uptrend is that we have higher tops and higher bottoms, or we say higher highs and higher lows. So in this market, we have higher highs and higher lows. And you see how clear the trend is. You can see clearly that we have higher highs and higher lows. That shows that this is an uptrending market. And in this uptrending market, what kind of trade are you going to be looking for? Of course, buy. In a downtrending market, on the other hand, what are you going to see? Let's look for a downtrending market. Let's erase this first. In a downtrending market, like this Euro USD chart I just opened, we expect to see lower lows and lower highs. And here is it. You see the price move down this way and then it corrects. Let me make this line thicker. The price moves down and then it corrects. You see how shallow the correction is. Then it pushes down again, correction, down, correction. You would see that every low is lower than the last and every high is lower than the last. So this is a typical strong downtrending market. Market is moving strongly to the downside. So higher highs and higher lows for an uptrend. When we start to see lower lows and lower highs, we know that we are in a downtrend. This is the simplest, cleanest way to identify a trend. When the structure is stepping in one straight direction, you know that you are in a trend. All right? Now, look at the pullbacks that we have here. If you notice, you would see that when we are in this uptrend, the pullback are clean. They are easy to identify. They are well controlled. They are not creating chaos. And when there is a dip, the buyer step quickly in again to start moving the price in the right direction. That is a clear trend that you can see there on gold. They don't break major structure levels. You will notice that here, as the price dip, the buyers will come in quickly to step back in and push the price up again. So for you to identify your trend, you can see that by simply looking at the highs and the lows. But another simple way you can do is maybe add a simple moving average or exponential moving average on the chart. I'm not a fan of loading the chart with a lot of indicators, but with a simple average added, let me add just 1 or 2 moving averages here. So you go to insert, you go to indicators, trend, moving average. Let's add moving average 50, exponential. You would see how the moving average is angled to the upside, showing us that we are in an uptrend. And you see how price come to test it or come toward it a lot of time. Let me add the 20. I'm going to make that one red. And you see the 20 is also well respected. So the moving average can be another tool or can be a tool you can decide to apply. If price keeps respecting the same moving average, that can be a good opportunity for you to find entry in the market. It can be your trend line. It can be the line you pay attention to in identifying the trend. So what strategy works here? In a trending market, this is a trending market, as you can see. In this trending market, you are going to be looking to trade pullback. What does that mean? The price retraces, comes back to the moving averages. You're finding a buy when it bounces off the moving averages. You may decide that you're going to add just a trend line, a trend line here. Simplify your strategy when you're trading in a trending market. You really don't need too much before you can start trading on your own. You can decide, I'm just going to put a trend line, or like we have added on the charts, moving averages. The moving averages I added are 20 and 50. So you can decide price retraces to the moving average and it's now bouncing up. Opportunity to enter. It may also be a breakout. The price has just broken out of in the direction of the main trend. Maybe the price had retraced before and then you place a line on it. For instance, I may decide that I identified this this area when it was retracing, it was forming within this consolidation. So I identify it. When the price breaks above it, that can be an opportunity for me to go ahead and do a buy, to know when to join in on the trend. When the price retraces, I can place my trend line above, and when the price break out, it can be the point when I find an entry. All right? What you want to avoid when you're trading a trending market is to avoid trading contra trend strategy. And what that means is that when the price is trending in an uptrend, I do not want to be looking for sell. Because yes, I can say, oh, but this is an engulfing bearish candle. If I had done a sell, I would have made some profit by the time it pushed down like this. No. You want to wait for the price to complete retracing, and then when it resumes, you join the buyers again. That is how to trade a trending strategy. All right? Because trying to pick the top and or the bottom, try to, sell high and buy low in a trending market will most likely drain your account. This is why people still blow account. They blow their trading account, not because their strategy is bad, but because they are using ranging market strategy in a trending market. Now, let's move on to look at a ranging market. A ranging market is where majority of traders would lose money without knowing why. This is the chart of Euro Swiss franc. Euro CHF usually referred to as a mirror pair, a mirror currencies. Like, they usually move in the same direction, and because of this, they range a lot of the time. So what do I mean by range? You will notice that the price is moving up, down within an area, within a top and a bottom. All right, so I can easily identify a level of support and resistance within which the price is ranging here. All right, in a range, price would keep bouncing between two zones, between the support and the resistance level. It rejected from the top and the bottom. Now let's identify a ranging market. This is a ranging market, and this is the chart of Euro CHF. Euro and CHF are considered mirror currencies. They usually move in the same direction, and that is why I choose it to easily find a ranging market, because majority of the time they are ranging. Now I will identify the ranging area here. You'd see, let's say we have a resistance level and then a support, So in a range, price keeps bouncing between two zones, between this support and this resistance. It rejects the top and the bottom repeatedly. A lot of the time it goes to, maybe it touches it or almost touches the resistance before coming back down, and then it gets to the support, price gets rejected again. No clear higher highs or lower lows are seen, which shows that there isn't a clear direction here. All right, now you will notice that there are a lot of wicks that you can find above and below. You can find that a lot of the time the price would form wick when they get to around resistance level. Sometimes the wicks will go above the resistance, sometimes they would stay below the support. These wicks that you're seeing are called liquidity grab. The market would use that opportunity to clear the stops, the stop losses that are placed above the last high, above the last low. So instead of the resistance of the price getting exactly to the resistance level, a lot of the time there will be spike like this. It will look like, oh, this is ready to continue down. It goes down, it takes out all the stops there, and then it comes back inside. In a trending market, the momentum is clean and clear, as we saw earlier. But in a ranging market, every push die quickly. The price looks like, oh, it is going to go up. Now let's look at this area. You'd see that the price pushed above this level, and it looks like, oh, we are now in an uptrending market. You'll start preparing to do a buy. But let's see, did this continue to the upside? In fact, it spent some times above that level that has been identified as resistance before now. The price spent some time above that level, but what happened? It pushed back in, moved to the other side, and actually continued to move in the wrong direction. It continued to move downward. So what works in a ranging market? The truth is, in a ranging market, in this kind of environment, pullback strategy would fail, breakout strategy fail, trend following strategy fail. So what works? What would work in a ranging market is you finding your sell around anywhere close to the resistance level, maybe after a touch of the resistance or the price had gone close to the resistance, and then there's a bounce, a good candle pattern like an engulfing bearish candle showing that the price wants to push down now. You do a sell and then buy near the support level. The price gets to the support level and it forms candlestick pattern or chart pattern that shows you that the price wants to move to the upside. So watching for forced breakout or rejection around the support and resistance, that's what works in a ranging market. So yes, whether we are in a trending market or we are in a ranging market, there is always a strategy for any of the market. All right? You do not have to apply the strategy that works in a trending market in the ranging market, because it's not going to work, the strategy that is working consistently for you in the ranging market is not going to work for you in a trending market. This is the skill professional traders use that most beginners keep entirely. You need to match your strategy to the environment. Ask yourself, is the structure clean or sideways? Are we seeing higher highs, lower lows or not? Are we bouncing between levels? If the answer isn't clear, you don't trade. This discipline alone will eliminate 50% of your unnecessary losses. Here is the simplest way to apply this instantly. Before every trade, Pause and say, trend or range? If the answer isn't clear within 5 seconds, you don't trade, because that shows trend is not clear and the trade will also be unclear. I want you to comment below and tell me which one makes you the most losses, trending or ranging market. Your answer tells me exactly what video to make for you next. Trading becomes much easier when you stop forcing strategies into the wrong environment. Master reading market condition and your setups will finally start working the way they were designed. Are you aware that MS Africa Academy, established in 2018, is the best place to learn how to trade? With experienced traders and mentors ready to hold you by the hand and work with you every step of the way. Our programs help you to learn from beginner through advanced level of trading. You have access to trading tools, community of traders, daily trade recommendation, and much more. You want to be a part of this? To be a part of this, click in the link in the description and learn more about our Forex Varsity program today. If you found this helpful, ensure to subscribe to this channel. More practical trading lessons like this are coming.